Hello and welcome to Lecture 5 of the Fiat Standard online course. Today's lecture's topic is Fiat Balances, and the subtitle of that chapter is Universal Debt Slavery. So in this chapter, chapter 5 of the book, the Fiat Standard, I talk about how fiat balances exist. And I think thinking about fiat balances and the way that the fiat system, or the fiat software, if you want to call it, treats people's balances on the network is very instructive on how the network works and how the network performs, and can give us a very good insight into why it operates in the way that it does in our economic system. In a gold monetary system, your balance of gold consists of the physical quantity of gold that you own, whether you want to measure it in ounces or grams, or in terms of specific currencies, the dollar that is based on gold or the pound that is based on gold. Under a gold monetary system, your balance of gold was very simply the physical quantity of gold that you owned, and it could be expressed in all kinds of different units, metric and imperial units, as well as currency units. But it ultimately reduced to a physical quantity of gold, a certain amount of gold atoms and grams. In the Bitcoin system, it's all satoshis. It's the system is about how many satoshis you have. So the way that it works is there's 21 million satoshis, and we're discovering them, finding them one at a time, or currently 6.25 at a time. Every 10 minutes, a new amount of Bitcoin is added onto the supply, and that's increasing the supply of Bitcoin, but it is increasing at a decreasing rate. But your balance of Bitcoin is how many of these satoshis your private keys can move. Ultimately, there's a lot of sophisticated details about how the Bitcoin network moves and works and operates, but there's a certain number of Bitcoin, currently around 19 million. So there's a certain amount of satoshis, and what it comes down to is how many satoshis your private keys can move. That's what it really is all about. So there's a certain number of satoshis associated with the private keys that you're able to control. And so everybody has a known balance on this network, and you know how much they have from this positive sum quantity of satoshis. But in fiat, things are a lot more complicated. So balances on the fiat network are first unquantifiable. Nobody knows exactly how much fiat exists, and there is significant disagreement over the correct method for calculating the fiat supplies. With gold, at least we can't really exactly count every bit of gold in the world. We never know exactly how much there is, but we know what gold is. It's this physical metal. With fiat money, it's not very clear what exactly constitutes fiat money, since it depends on what you consider money. And since money is created from debt, a lot of this money has different maturity. So depending on the maturity that you accept of the money, in other words, how readily available that money is for the person who owns it, then your definition of money changes under the fiat system. So M0 is considered the money that is generally considered the physical money, the coins and notes that you hold. M1 is considered the cash deposits, money that's available on demand. So your checking account, money that you could call on immediately in order to make a payment. And then M2 and M3 start including other kinds of financial assets that have a longer maturity that are not available on demand. So it depends on which one you would like to count as money. That determines what is money under the fiat monetary system. And there's no clear-cut answer on what measure actually constitutes money, as the nature of fiat is to continue to conflate future fiat with present fiat. So it's not really clear which one you should really count. In the Bitcoin standard and the fiat standard, I like to go with M2 as the measure of money, because it is the one that we have the most regular and comparable and standard statistics for. So we can have there's World Bank data on M2, and there's OECD data on M2 that basically cover the entire world. And if you look at them, you'll get a good idea about the money supply increasing across different countries according to some sense of standard measure. I don't think these things are 100% accurate, because different countries count differently, and different countries' monetary policies and monetary systems work differently. But nonetheless, this gives us a good idea about broad money supply measures in the long term and the trends in their movement in the long term. We can see this from this data because it is comparable. And so more important than the exact amount of money is the change in money over time. And this data, by using this measure that is consistent across time and across countries, gives us the best ability, in my opinion, to think about long-term movement in the money supply. So we go with M2, and it's a wide measure of money, but there are wider measures. You could do M3, and some countries even have M4. Then the other thing about fiat balances is that they're irreconcilable. So you can't run the numbers as Bitcoiners so much enjoy. You know, one of the amazing things about Bitcoin is that you go on your node and you can see just how many Bitcoins there exactly are in the entire network. And the network performs full reconciliation every 10 minutes between all members of the network. You know, every 10 minutes we're tallying all the balances, and everybody knows exactly where each Satoshi on the network is. There's 2.1 quadrillion Satoshis on the network roughly, and everybody knows where each one of them is every 10 minutes. That's not the case with fiat. With fiat, money is constantly being created and destroyed in all these different financial institutions. Remember, we said earlier that fiat mining is lending. So all those institutions that issue loans are constantly creating money and destroying money. So the money supply is constantly rising and declining. And so there's no easy way of tallying the money supply at any point in time. And there's no easy way of tallying everybody's assets and liabilities. You can't figure out exactly what is going on in the system. And that's why, arguably, the system is very ripe for fraud. And there's a lot of inconsistencies about the supply and where money comes and goes, and a lot of concerns about money laundering, and a lot of concerns about banks engaging in these things, because banks have a very, very good position that allows them to create money. So think about the limitless possibilities. If you were in some international criminal, think about how advantageous it is to have control over something like a fiat bank, because you make your own money and you destroy money based on debt creation and debt repayment. So that allows you a lot of leeway for operations. So I don't think it's a coincidence that we see a lot of organized financial crime take place in the fiat system, because you allow entities that get a lending license to create money and protect them from the consequences, because central banks bail them out. The other thing about fiat balances is that they are tentative and revocable. And so you never really have an actual fiat balance. You never know at what point in time your fiat balance can be revoked, whatever form it takes. So if you have a bank account that can be confiscated, as we saw happening in Canada recently to political opposition, as we saw also happen to Russia and Afghanistan. Governments that weren't getting along nicely with the US government had their access to the global financial and monetary system essentially cut off. Any balance can be revoked at any time, and it can be confiscated. And that's why effectively there's really no final clearance. You never really have your money in the fiat monetary system. And even if you do take it out, even if you do take out your money from banks into physical forms of cash, even then your money can effectively be revoked, because your notes can be destroyed in value through hyperinflation, or they can just be destroyed in value through fiat. There'll be an announcement that these old notes don't work anymore, and if you want money, you have to exchange them. So then you need to go back to the government and declare all of your money. So effectively, they continue to be able to revoke value from all of these fiat forms of money. You never really own fiat. Whereas, with gold, with Bitcoin, effectively you do own it. If you take physical possession of gold, the only way that it can be taken away from you is through force. And similarly with Bitcoin, if you have possession of your private key, the only way it can be taken away from you is through force, although with Bitcoin it's even more complicated, because it can be memorized, in which case force might be futile in getting it out. Number 4 is, and I think this is the most significant one and most important analytically, is that fiat balances are negative. And this is almost the gravity-defying, physics-defying nature of the fiat monetary system. You would think that an accounting system that uses a form of money, where the money is used in order to make transactions between people, you would think that sort of thing would run positive numbers. You're moving money between people, and some people have money, some people have stuff, and then they exchange money and stuff, but the total amount of money has to always be positive. Well, not in the fiat system. In the fiat system, we can actually have a total of fiat tokens that is negative. In other words, if you add all the people's fiat balances at any point in time, it is enormously negative. If you look at the total amount of debt outstanding at any point in time, it's far larger than the total amount of money. So the world is in far more debt than it does have money. Most people have more debt than they have money. So people borrow to buy their house, they borrow to buy their car. And so the amount of money that they owe on their house and their car is larger than the amount of cash that they hold. So effectively, your fiat balance in that situation is negative. This, I think, is massively amazing as an idea if you think about it. Why would it be the case that we end up with everybody running a negative balance? How can we do a negative balance? Shouldn't the money be borrowed from someone? And the answer is because of the enormous incentive to accumulate debt, because fiat money monetizes debt, and because the native token is not physical or scarce in any real sense, financial institutions are constantly generating negative balances for their client. There's an enormous incentive to get people in debt, because every time you get somebody in debt, you're able to create money. So the desire to borrow and the desire to lend at financial institutions is going to go far beyond the ability of people to provide positive savings. The financial system is just going to continue to create more debt than there are savings, and it's going to try and get everybody as much debt as is possible. And the more that the debt balances grow, the better off the bank is, and arguably the better off their customers are, because ultimately the reason this is a rational strategy in this system is because the currency supply is rising. So the value of the fiat is declining, and because the value of the fiat is declining, it makes sense to be short fiat. And so everybody wants to be short fiat. Everybody wants to borrow. So people will borrow beyond any kind of reasonable expectation of what you would expect under a hard monetary system, such as the gold standard or a Bitcoin standard. Under the fiat system, everybody is constantly borrowing. Any source of income is always used to be borrowed against. People base their lives around debt. All expenditures around debt. Businesses base their lives around debt. Governments base their lives around debt. Whether you agree with it or not, whether you think it's right or wrong, is kind of beside the point, which is the economic point, which is that this is why this stuff happens. The reason this stuff happens is that there is a very strong incentive for the creation of debt, because debt is mining money under the fiat system. So everybody gets into debt.
The Bitcoin Standard podcast is brought to you by thesafehouse.com, my independent publisher and bookshop, selling the best Bitcoin books in high-quality cloth hardcovers built to last for generations. Most books these days are pretty fiat. They're flimsy and they fall apart quickly, and I did not want that for my books, so I set up the Safe House especially to provide you with beautiful, long-lasting classic cloth hardcovers you can proudly pass down for generations. You can get copies of my 3 books, The Bitcoin Standard, The Fiat Standard, and Principles of Economics, and you can also get copies of Lynn Alden's Broken Money, Parker Lewis's Gradually Then Suddenly, and Matthew Lysiak's Fiat Food, to which I contributed a few chapters, and Mexican billionaires Ricardo Salinas Pliego's new book, The Bitcoin Enlightenment. We now offer bulk discounts so you can buy books for yourself and for the friends and family you'd like to learn about Bitcoin. Buy any 2 books for $50, any 5 books or more for $20 per book, and for more than 50 books, it's only $15 per book. Go to thesafehouse.com, the SAIF house.com, where you can get all of these books in high-quality cloth hardcovers, delivered worldwide, and get 10% off for paying with Bitcoin. The Bitcoin Standard podcast is brought to you by the Daylight Computer. I love to work early in the morning and late at night, or in the sun outdoors, but regular computer screens are terrible at these times, and they strain your eyes. For years, I've wanted a paper-like electronic screen on a simple computer I could use to write. I tried several models, but none were very good. Now, finally, Daylight have delivered a fantastic full-function tablet with a paper-like screen that's easy on your eyes and great for outdoor use. I've been using the Daylight computer to write my next book, and it is absolutely fantastic, and it has led me to invest in this company myself. Check out my interview with Anjan Kata in episode 249.
But it isn't exactly that everybody gets into debt. It's more accurate that people who are rich and who have high incomes are able to get into debt, whereas people who are poor are in the lower tier of the system who have to use the physical money. And those are the people who have positive fiat balances. So if you're poor, you don't have access to a bank loan, your wealth is stored in physical paper money, or maybe you might be able to afford a deposit account at a bank, in which case your money is stored in the deposit account or in a saving account, but you don't have the ability of borrowing. In this case, if you have a positive balance of fiat, you are getting hurt. And that is the majority of users of fiat. If you think about it in terms of numbers, I think the majority of the people in the world are unbanked and they are not able to get loans from financially regulated fiat institutions that allow them to benefit from the inflationary Cantillon effect of credit creation that we discussed earlier in chapter 3, in lecture 3. So the majority of the world's users are stuck with physical paper money. They're stuck holding their savings and their wealth in physical paper money, and they're witnessing their wealth lose value. But the richer minority, the richest maybe 20, 30, 40% at most, I think, of the world's population are able to have bank accounts connected to central banks and therefore are able to borrow from a central bank that is creating currency through debt creation. And so therefore by borrowing, they end up with a negative balance. So the rich people are the ones that have negative fiat, and the poor people are the ones that have positive fiat. So poor people will have a small amount of fiat, and that's all their wealth. Rich people will have a small amount of fiat too, which is basically their pocket change, but they'll have a lot bigger amount of debt, and they'll hold hard assets, which they bought with that debt. So rich people will have houses, businesses, stocks, cars, real estate, commercial real estate investments, but they will hold those things as an asset while borrowing in order to finance them. So they have hard assets, but their fiat balance is negative. They owe a lot more fiat than they hold fiat. And that is why they're rich. I mean, they can do that because they're rich, but it's also why they stay rich. And that's why under the fiat system, the rich keep getting richer and the poor keep getting poorer. Because the way that the system works is you're subsidizing the borrowers at the expense of the savers. And the borrowers are the rich and the savers are the poor. Obviously, the biggest borrowers are the richest people who are able to borrow the most. And in particular, the biggest borrowing entities are the biggest financial institutions as well as the biggest governments. Those are the ones that are able to borrow the most. So they benefit the most from the depreciation of the currency because their liabilities go down in value. Whereas the people who are not borrowing, or the low tier users, they are the majority of the users who hold a small amount of wealth that is small individually, but huge for them. They have a few $100s saved or a few $1,000s in life savings. And these people have them in physical cash or in saving accounts. And these people are constantly having their money devalued day after day, year after year to finance and benefit the borrowers. This is how the fiat system kind of works. And so holders of positive balances are constantly being robbed through inflation. Holders of negative balances are always insecure. And so they're about 2 missed loan repayments away from devastating bankruptcy and a loss of collateral. So just because you're rich in the system and you're making money doesn't mean that you're happy, because you're very insecure, because you have a negative fiat balance, you're in debt, and you miss 2 paychecks, and you can't make a payment on your house. You lose your house, you can lose your car, you can lose your business, you can lose your investment. Everything is running on debt, and therefore everything is collateralized effectively, and therefore everything can be taken away. So even if you're rich, you can't really buy security, financial security, in the sense of having a stable amount of liquid wealth saved for the future, is no longer available for anybody really in the current system. Fiat has effectively destroyed savings as a financial instrument with enormously negative consequences. You can't save. If you save, you expect your money with fiat, based on the track record of the last 60 years, you expect your money to be devalued by 50% in 5 years. So if you work for 10 years, you're going to lose half of those 10 years that you've worked for in 5 years' time. So if you spend half of them, the other half that's left at the end of the 5 years is going to be worth half of what it was when you first retired. So That's no viable strategy. You can't just buy financial security through liquid savings that last. You have to go out and find a way to beat inflation. And that means that you can't really retire. You can't be financially secure. You have to always be gambling. You have to always be taking on debt. And you have to always be out there trying to beat that infinite treadmill of fiat inflation, which is forcing everybody to be poorer every day in order to essentially finance government spending and benefit the banking system. The impact of fiat then on savings is that it has destroyed our conception of savings and destroyed our ability to save. Saving is the deferral of consumption from the present to the future. Holding durable goods is the first form of saving. So, you build something that you use, you build a house where you stay, and that's a durable good and stays around for a while. That's a form of saving. You could have spent your time enjoying yourself, or you could have spent your time producing food, but you invested in a durable good because you saw the value of it, not just today, you saw the value into the future. So this is, in a sense, saving. You're saving the good for the future. But with the development of money, it became the most efficient medium of saving. Money quickly established itself as the best way to save because it is liquid, it is fungible, and it can be exchanged easily for other goods. That's the best thing about it. If you save physical goods, in the future, that is only beneficial to you if you need those same particular goods in the future. But if you save liquid wealth in the form of money, in the future, it's beneficial for you and it's useful for you, whatever it is that you want. Whatever you want can be exchanged for money the most easily. So the goods are useful as methods of saving as long as you know that you want to use them. A house is great to store value in if you know that you're going to be there. But if you know you're going to be there in 5 years or in 10 years, but if you don't know if you're going to be there, then it's not very good because you need to sell it. And it's not as liquid as money. It's much easier to sell money and buy a house than it is to to sell a house, buy money, and then sell the money and buy the house. So money is the most liquid good. So it's much more useful as a method of saving. And as money becomes harder, as I explained in the Bitcoin standard, as money, we naturally tend toward the money that is the hardest because wealth is preserved in harder money. So money is almost always harder than the things that we have, the other objects. So money holds on to its value generally. Hard money, gold did. It holds on to its value better than any kind of consumer good or any kind of durable good that you could hold on to, because durable goods decay much more. And durable goods, more of them is constantly being made, so the real market price is declining, whereas money is the thing that is the hardest to make. So generally, you're making more of everything than you are making more of gold. And so therefore, the value of it tends to go up over time. So with the development of money, we really supercharged our ability to save and provide for the future from a world with no money. And so that increased our ability to provide for the future. And it increased our ability to think of the future and reduced our discounting of the future. In other words, it lowers our time preference. And that's why, I think time preference is a very important concept, and I talk about it extensively in the Bitcoin standard and in the Fiat standard and in my next book, the Principles of Economics textbook. Time preference refers to the degree to which we discount the future. And that is always positive. We always value the present more than the future. If anybody is given the choice between something today or something in 10 years from now, they prefer to have it today. Always. You always prefer the present to the future. It's true. But as we develop better ways of providing for the future, as we start being able to save with money that is very good at holding on to its value for the future, the uncertainty of the future declines. And since the uncertainty declines, we start discounting the future less. We start valuing the future more. And therefore, we start providing for the future more and more, and we start thinking about it more. And that's essentially human progress. That is civilization. That is the process of human civilization. It's when we provide more for the future and think about the future, and we lower our time preference and we focus on building things that provide a return into the future rather than just satisfying our immediate needs. So humanity, really, we can think of human progress and civilizational progress as being almost intertwined with monetary progress. We keep finding harder monies, and these harder monies allow us to save more. And then because we save more, we are able to invest more. We can think of the future more. We lower our time preference. Our productivity increases. Our standard of living increase. And because we lower our time preference, we become better humans. We become more cooperative. We become more likely to understand each other and work and cooperate with each other rather than fight and conflict with one another. So we develop this lower time preference because our money allows us to see into the future. And then all throughout human history, we're developing harder and harder monies that have better salability, that allow us to spend the money better across time and across space. All across history, we're developing this until we get to the gold coin at the end of the, at the gold coin and then the gold standard, where, anybody could earn a gold coin, and all you had to do was just maintain this one same gold coin that you earned, keep it, and that almost certainly would appreciate over time. Gold went up in value slightly every year, and anybody could save. So therefore, the future was easily available for everyone. Anybody could buy their future self some economic wealth by buying gold today, and that was the same thing that you earned. So if you had a job, you were paid in gold, and you just had to hold on to the gold, and future you could have the earnings of past you having appreciated over time. So anybody could save what they earn, spend it anywhere, and know the value would be held across time, because the gold supply would only increase at around 1 or 2% per year. But then fiat comes along, and it sets back monetary technology millennia backwards. Supply growth rate was around 7% in the best cases, up to several 100% in the worst cases. So we go from a world in which our money supply is increasing at around 1-2%, so we know with a lot of certainty that we can provide for the future, to a world in which our money supply is growing at around 7% in the best of cases, but the average over 60 years was around 14%. So from 1.5% to about 15%, so almost a 10x in the supply growth rate. And so this basically set us back because it took away from us the ability to provide for the future. Saving became much more complicated. So let's think about how saving has developed under the fiat monetary system because of this way that the system works in which it encourages debt, and because of the inflation that destroys the value of the currency. So first of all, if you try to save in cash, obviously the cash is going to lose its value. So that's not going to work. So investors turned to the stock markets in the 1920s, which caused the stock market crash. And we can think of the stock market crash as the easy money trap that we discussed in the Bitcoin standard. Why did everybody go to the stock market in the 1920s? Well, because there was inflation, there was a lot of credit being created. And so everybody wanted to find a way to invest that money to make more returns. Because of the inflation, that led to an increase in the valuation of stocks. And that increase in the valuation was driven not by the fundamentals of the value of the companies rising, but rather by the fact that the companies could access more credit and that a lot more people had more money to buy their stocks. So that drove the valuations of the company beyond their fundamental value implied by their returns. And that made them effectively a store of value. People were using them as a way to store value into the future. But that doesn't work, we can't use stocks as money because eventually it's going to be unsustainable. Whether it's stocks or copper or real estate, with anything that is not hard to make, if you do use it as money, you're just going to create more of it. So more stocks were produced by the companies, more companies were listed, and fraudulent companies and companies that produced nothing were listed on the stock market because everybody wanted to buy stocks. Once you get to that point, the illusion can't really be maintained for much longer. Maybe it can with a lot more inflation, but there comes a point where the lie has to die because it's not sustainable. So the stock market failed in the 1920s. And as a result of that, in 1934, the way that they tried to fix the failure of fiat to provide people with savings, because the stock market failed and it destroyed people's bank saving accounts as well. Everything went down because everything was intertwined. And so in 1935, they introduced the separation of commercial banking from investment banking. So the idea was that we're going to keep people's savings accounts and checking accounts separate from investment banking so that speculation on companies and all of that stuff is not going to affect people's saving accounts. And the idea was that, the commercial banking, your saving account will be safe and it will offer you an interest rate that can reliably beat inflation, but without there being risk. without you taking risk. And the way that they allow banks to do that is through inflation. So you're really, it's like the donkey that has the carrot laying in front of them. The more you run to get to the carrot, the further away the carrot goes. The person is holding the carrot in front of the donkey, and then no matter how much the donkey walks, the carrot keeps going further ahead. And so this is the idea of, we're just going to do inflation with banking just to finance savings interest rates that beat inflation is obviously nonsensical and it can't work. And so the way that people tried to beat inflation was to get back into the stock market and the bond market. So it worked briefly and exceptionally after World War II as the world adopted the dollar, causing its value to increase and finance government deficits and inflation. It worked in that exceptional period because in that exceptional period, the US could do anything and not suffer inflation because it was just printing money and handing it out to the rest of the world that was taking it. And the US didn't have to maintain gold cover very strictly, and as we saw in the 50s and 60s there was a lot of inflation, but it was covered up by the fact that people were buying it. And then in the 60s, late 60s, the money printing had gotten to a point where the US could nowhere near offer redemption of all of its outstanding dollars in gold, which is what it had promised to do. And so they canceled the gold exchange window. And that's when the inflation picked up. So it was never sustainable. The idea that we could just go back to this world of 1955 where inflation was low and savings accounts were offering these higher interest rates, in my opinion, is not sustainable. After 1971, this became clear. The savings accounts were no longer beating inflation. And so the way to meet that was to get into bonds. And so in the 1970s, we go into the bond market. The bond market becomes the saving account. So we go from gold coin to saving account, interest-bearing saving account, to bond market. Just lend your money to the government and then the government will pay you enough. And don't worry, the government will always be able to pay you because, they can always print money. So don't worry about it. You're getting paid in freshly printed money. What could go wrong? This, of course, led to the growth of the modern cancer that is this gigantic monster that is the bond market, which is an enormous subsidy for governments and inefficient large corporations that are connected to fiat money generation, because it allows them to borrow. And it's specifically a very big subsidy for governments because governments, unlike corporations, they can print their own money. And so one interesting fact to keep in mind is that if you look at governments' ratings, basically if you looked at the balance sheet of a government and you ran the numbers on the government's revenues and expenditures and you saw what it was performing like and looked at its expectations, with these kind of numbers, you would rank the US government as a B minus. But based on the numbers that they use for credit ranking, the EBITDA over interest ratio, based on these numbers, this is how they qualify companies according to their rankings. And that then in turn determines the interest rates that they pay. So the US government would be a BB minus borrower. But because of the fact that it has a money printer, it gets a AAA rating. So to justify its AAA rating without fiat privilege, without the ability of printing money effectively, the US government would need to have an EBITDA 20 times larger than its interest payments. In other words, its income would need to be 8 times higher than what it currently is, or its expenditures would need to be 8 times smaller. So the current fiscal state of the US would be justified on the free market without the printing money if the US could manage to spend an eighth of what it is spending, or if it could manage to earn 8 times what it is spending. As it stands, the US is basically junk bonds. The US's fiscal position is junk bond. It's only because they can pay you in inflationary fiat credit that they make themselves that you think of it as AAA, but the joke's on you because you're the one who's getting paid in depreciating money. The Bitcoin Standard Podcast is brought to you by CoinKite. CoinKite are my favorite makers of Bitcoin hardware. They produce the legendary Open Dime, the first Bitcoin bearer asset, as well as the reliable Cold Card hardware wallet, the excellent stainless steel seed plates for storing your seed phrases, and the block clock. Now, CoinKite have produced the Sats card, a card the size of a credit card which can store Bitcoin and works great as a gift.
CoinKite have just produced a limited edition gorgeous Bitcoin Standard Sats card, which carries the Bitcoin Standard logo, and you can get it from coinkite.shop/Bitcoin Standard. Use the code Bitcoin Standard to get 5% off your purchase. This podcast is also brought to you by the Bitcoin Way, your professional Bitcoin IT team offering you personalized, secure, and comprehensive solutions for every step along your Bitcoin journey. The Bitcoin Way offer live concierge service to guide you with your Bitcoin cold storage, running your node, privacy best practices, inheritance planning, corporate strategy, and multi-sig solutions. They don't touch your coins, they guide you through the process of acquiring your coins and securing them. If you'd like to make your setup safer and more reliable, book a consult with them and see what they have to suggest. If you want to give someone the gift of Bitcoin, get them this professional service that will ensure they start off knowing exactly how to manage their coins and not lose them. Go to thebitcoinway.com and start Bitcoining more confidently.
So the bond market worked for a while as a saving mechanism, but of course monetizing bonds just created a massive boon for governments and corporations to borrow, leading to an increase in bonds and returns that cannot beat inflation by late 2000s. And arguably much earlier, depending on how you calculate inflation. We know now definitely that bonds don't beat inflation. It depends on when you think that was the case that happened, but arguably it's been there for a few years, maybe a couple of decades, that bonds don't beat real inflation. It depends on how you measure inflation. But if you think about it in terms of the desirable goods that you want, then bond returns don't beat that. And so, particularly after 2008, 2009, with the inflation that happened and all of the quantitative easing, the stock index then became the new saving account. And so you couldn't just put your money in bonds in order to save it for the future. You had to get into the stock index. And that was considered like the safe bet because, there's always things going on in capitalism and companies making new things. And if you bet on the index, then you're just betting on all of those companies together. And they only have the best companies there for you. So you'll be all right. But of course, investing is not saving. Investing is a cash outflow while savings are held on a balance sheet. So there's a very categorically different things. Cash is required for salability. Investments are acquired for cash flow. Investments involve risk. Cash, the point behind cash is that it involves the least risk. People would keep a cash balance they would like to have with certainty and would risk their investment funds in search of returns. This is how it usually worked. There was the cash balance which you saved, which you wanted with certainty, which you wanted to know that was always there for you, which you would expect to appreciate slightly or at least not lose value over time. And then once you have that little nest egg secured, then you can take risk with some of the other money that you have. And then you would invest. And that's the role of investment, is for people who are able to take the risk and who have the time to study the risk and to figure out what they can do with it, and who can stomach the risk because they have their nest egg in something that is safe and reliable for the future. So the problem with fiat is that simply maintaining the wealth you already own requires significant active management and expert decision making. You need to develop expertise in portfolio allocation, risk management, stock and bond valuation, real estate markets, credit markets, global macro trends, national and international monetary policy, commodity markets, geopolitics, and many other arcane and highly specialized fields in order to make informed investment decisions that allow you to maintain the wealth you already earned. You effectively need to earn your money twice with fiat, once when you work for it and once when you invest it to beat inflation. The simple gold coin saved you from all of this before fiat. Why should a doctor, athlete, engineer, entrepreneur, or accountant who is successful in their field have to develop expertise in these many fields just to maintain the wealth they already produced and earned freely on the market? Given the rate of monetary inflation financing wasteful government spending and the high fees charged by the investment management industry, only a small minority of investors can reliably beat monetary inflation in the long run. The vast majority must continue to work harder and earn more to not lose wealth. But fiaters often respond to this by saying, well, economic growth compensates for inflation. Does that make sense? Well, no, it does not. First of all, the economic growth happens because people work. It doesn't happen because of inflation. The inflation is the parasite on the economic growth. It is not the cause of the economic growth. In the same way that, if you have a tapeworm in your stomach, it's not what's causing you to grow. You're growing in spite of the tapeworm, not because of it. So the fact that you're growing even while you have a tapeworm is not an argument in favor of tapeworms. So economic growth is not dependent on inflation. Economic growth happens because of saving and capital accumulation and production and technological innovation. That's what, and because of trade and division of labor. It's people who are actually out there doing things. Inflation is essentially taking wealth from the people who are doing things and punishing them for producing and rewarding people who are not doing things. So the idea that it is the inflation that is causing this is, I think, absurd. Even if inflation does, even if economic growth does overtake inflation, it does not justify inflation, and it still means that the theft of inflation has occurred. It has taken the wealth away from the people who lost it because of the devaluation of their currency, which they have no choice but to use. And as interest rates drop to negative territory, and currently, it's becoming very difficult to find investments that can beat inflation. Even lending to highly incompetent governments now comes with a negative nominal return, effectively expropriating investors while also subjecting them to serious risks. So we're seeing now this system come to its kind of end where they can't even offer people the facade of savings anymore. You can't really make savings because even the bonds get into lower territory. And so what is the strategy? How do people deal with this? What do you do in a world in which you don't have savings anymore? You get into debt. The correct and successful financial strategy under the Fiat standard is to constantly take on as much debt as possible, to be meticulous about making all payments on time, and use the debt to buy hard assets that generate future returns. Doing this successfully improves your credit score and allows you to borrow at lower rates while you store your wealth in goods that cannot be inflated as easily as fiat. The fiat system taxes savers and subsidizes borrowers. This is how it works. The fiat standard encourages everyone to live fragile lives and take substantial financial risks. The alternative is a slow, continuous bleeding of wealth. Businesses that are more reckless in taking on debt are more likely to fail than those that do not, but they are also far more likely to grow and drive competitors out because they can borrow at low rates and they can drive their competitors out at higher rates. In the fiat standard, those who choose to hold positive balances are robbed as the purchasing power of their fiat is eroded by all the debt others are creating. Those who are in debt, on the other hand, get to benefit from some of the seigniorage. Not taking on debt is reckless financial responsibility. So Irish economist Richard Cantillon described the distributive impact of inflation as benefiting the people who receive the newly created money first at the expense of those who receive it later. This is what is known as the Cantillon effect. And in the modern fiat standard, the beneficiaries of the Cantillon effect are the borrowers and savers are the victims. Spending less than you earn and keeping savings on hand are simply no longer optimal financial strategies. They are expensive luxuries most cannot afford. The path to financial success under the fiat standard lies in acquiring hard assets. Financing these acquisitions with debt is even more profitable. Not only is inflation likely to devalue the loan for the asset more than it devalues the asset, but as the lender and borrower are partaking in fiat mining, there is enough benefit in the mining seigniorage to make the purchase cheaper for the borrower. The most profitable route, however, comes from being able to issue fiat and get others into debt. And so that's why, under the fiat standard, every business model degenerates into interest rate arbitrage. The purpose behind setting up business is increasingly less about making money from serving customers, but establishing a creditor relationship with them. The consequences of fiat balances being negative is that everyone is constantly in debt. Your home ownership is contingent on you fulfilling your financial obligations for decades. Your future depends on you and many others fulfilling financial obligations in a timely manner. Your future uncertainty is higher than what it would be if you could place your wealth in a hard money, and that causes a rise in time preference. Everyone is less peaceful and more insecure. The age-old wisdom of every grandmother has been turned on its head. Instead of saving for the possibility of a rainy day, fiat makes you borrow against all of your future sunny days. And then the chapter ends with the example of the narrow bank, which is a bank that tried to offer people basic savings. And what they did was they said they're going to deposit their bank capital at the Fed and get the interest rate that the Fed charges. And that's basically what the interest rate that only banks can get, which is the lowest interest rate and the safest interest rate. And you know, the Fed is the safest creditor by definition, because it can create the money. So it'll be the last person to ever go bankrupt on the fiat system. But you and I can't just get an account with the Fed. We can't deposit money directly. So what this bank thought that they would do is that they would just simply deposit their clients' money in the Federal Reserve and take a cut from the interest rate that the Federal Reserve pays them. And even though this doesn't beat inflation in real terms, because it is at least highly risk-free, because it is the least risky asset available in the fiat system, a lot of demand would exist for this. And the reason that the regulators did not approve it is because they thought this would be better than a lot of the money that's out there in the financial markets. People are putting so much money in the financial market. They would value so many people out there would value having a part of their portfolio that offers either a positive return or a small, even a negative return, as long as you had a very high certainty about the return of your asset. People want savings, and the fiat system takes it away. And the fiat system recognizes that people want it because it bans this narrow bank from operating, because if it did operate, and that's the important thing about the rationale, it wasn't that they thought that the bank was dangerous for the clients. They thought the bank was dangerous for the banking system. If this bank would operate, so much money would go out of other banks and other Ponzi's and the rest of the Ponzi's of the fiat monetary system, because people would just rather have this part of their portfolio that is safe to go to this bank, that it would threaten the safety of the rest of the financial system. And that tells you a lot about the safety and the market judgment on the fiat monetary system, that it would not survive if you had the free alternative of something that offered reliable, slow devaluation of your money, as long as it would get you back most of that money every year. So I think this is a very profound way of thinking about how the fiat monetary system works, and it helps us understand why the whole world is in debt, why corporations are in debt, why individuals are in debt, why governments are in debt, and why there's such strong incentive for debt propagation. So, and we'll discuss more about this and the rest of the topics of the implications of the fact that everybody is in debt in the second section of the book, which begins with lecture 7. So in 2 weeks, basically.